Hello, MakerDAO community. Thank you for joining the 46th Collateral Onboarding Community Call. Today we are joined by three of the team members from Pando, and they are presenting investment grade climate assets for onboarding to the MakerDAO system. We're joined today by Morgan Wright, who is the CFO, Dory, who is the CEO, and then Peter, who is the Chief Investment Officer, who will be taking us through most of the presentation today. As you guys have questions, the team here is very open to and wants to make this an engaging meeting. So please feel free to drop them into the call and we'll address them in real time. Also, want to call out again the raised hand feature in the Crowdcast system. If you need help with that, please use the chat feature as well to be brought up on stage. And from there, I'll hand the mic over to Peter and the Pando team to get this kicked off.
Thanks so much. Appreciate it. And we're really grateful for everyone taking the time to listen to this, either live or in the recording. And as mentioned, please feel free to ask questions. And if we're going to address the topic later, we absolutely will just tell you we'll address that later, or we can stop and discuss a topic at any time. So as mentioned, I'm Peter O'Rourke, joined by Morgan and Dory. And we'll just kick off right into the presentation. At a high level, the transaction we brought to Maker is effectively just a loan for solar assets. Those loans happen to be collectively investment grade. The assets are cash flowing solar PV installations on residential rooftops in the United States. The structure is a highly commonly used project finance structure. Given the large number of homes in the transaction, it's a relatively low risk of default for the senior lender, which would be Maker. And even as further protection, the transaction is going to be rated by Kroll, bond rating agency. Kroll is one of the four main rating agencies in the United States, and they rate a lot of the Mosaic Solar loans. Importantly, from our perspective, Maker would be earning a yield that is uncorrelated to the crypto market, so real-world cash flowing assets. And the opportunity is also broader than just earning cash flow from assets. Also is a really interesting opportunity, we believe, for Maker to get into a very mature market where tier one traditional finance lenders are very active. You'd be lending to assets that Credit Suisse, Deutsche Bank, John Hancock, and other tier one traditional lenders are actively participating in. And importantly, Maker is the senior secured lender in this transaction. Your cash flow would be above both Pando's at-risk yield. We'll get into what that means. And you'll also be ahead of the residual junior capital in the waterfall. So again, high-level overview of the transaction that we'll get into in a lot more detail. Firstly, though, who's Pando? There are four principals in Pando. Two of the principals are formerly from Mosaic. Dan Rosen is the former CEO and one of the founders of Mosaic. And Dory used to be the head of product for Mosaic. In addition to Dory and Dan, there's Morgan and me. Morgan and I have been working together for many years, as Dory and Dan have been working together. Morgan and I came out of the U.S. Department of Energy's loan program, where we deployed about $60 billion in energy project finance transactions. We also created a roughly $500 million registered investment advisory firm for solar tax equity. Collectively, the four of us have 70 years of experience. Unfortunately, my 30 years is a disproportionately large number of that, but I guess it's just being old. And we really tried to make sure that we're structuring this the right way, both from a traditional project finance structure standpoint, but also from a crypto standpoint. So we have Perkins Coie, Morrison Foerster, and KPMG all engaged to make sure that we're structuring this the right way. So I think we've surrounded ourselves with very high tier advisors. Moving into the other party to the transaction, in addition to Maker and Pando, is Mosaic. Mosaic is a residential solar finance company. They've been in business for over a decade now, and they've done over $7 billion in loans, including with partners like Tesla, Sunrun, and SunPower. They're really considered to be the leader in this space. Their structure they use is a very common structure where they just have a warehouse facility that houses loans until it reaches a certain size. Those loan tranches are then rated by Kroll if it's a bond rating, if it's a bond asset, and then they're then sold to the public markets. We have chosen and have asked Mosaic to actually rate a pool of loans, not bonds, to give Maker that extra protection that you actually have a credit rating assigned to these investment grade credit rating assigned to these solar loans. When Mosaic typically does forward flow or whole loan purchase facilities, they do not have that rating. But Pando is willing to pay for that rating so that Maker is further protected. So that's a relatively straightforward business model for Mosaic, but happy to answer any questions on what Mosaic does. Getting into our actual proposed structure with Maker, we're looking to borrow $210 million approximately against, an approximate $250 million pool of Mosaic loans. The remaining value, that roughly $40 million, would be funded by a junior capital provider. The loan will be backed by, as we've mentioned, prime quality residential solar customers. The whole loan that we will be financing will be rated BBB+ by Kroll using standard methodologies that are publicly available. We're assuming right now around 5,000 US residences would be in that pool, and the weighted average FICO for that would be, per our term sheet with Mosaic, would be at least 700. And for those who are not familiar with the FICO score, who might be outside of the United States, that's just a way to assess the creditworthiness of an individual. Maker's net yield we're proposing would be around 3%. That is after servicing costs, payment agent costs, costs for SocGen to structure it, after the costs for Kroll's rating fee, and then after the Pando yield that is at risk. And so we're assuming around a 3% yield for Maker, which again, our view for a solar loan and for most loans is pretty consistent with an investment grade publicly rated security. The tenor for the individual solar loans can range from 5 to 25 and even possibly 30 years. The actual loan we are proposing with Maker would be 14 years with a weighted average life of 6 years. Weighted average life, for those who are not familiar with that term, means basically when 50% of the principal, that 210, is returned. And we can show you what that means graphically a little bit lower. The servicing agent for this transaction will be Mosaic, but they have an already contracted backup servicer. For some reason, Mosaic disappears. Further on the structure, as we mentioned, Maker is in the senior secured position. The base case includes a very strong junior capital layer, but there's also a reserve account that will be funded at closing, which is added protection for Maker should there be very large defaults. If the reserve account is depleted, then the junior cash flow is used to make up any gaps in payments of P&I to Maker. And if that is depleted, then Pando's yield is used to service Maker's debt. So simply, just from a pure cash standpoint, we have 3 levels of protection for Maker. Historically, you see about a 1% default rate annually for Mosaic Solar loans. They get recoveries in the 20 to 30% scenario, but when Kroll underwrites this, they look at about a 7.5% default rate. So it's a very conservative underwriting by Kroll. Importantly, however, regardless of the first 4 bullets and 1 sub-bullet, the homeowners would need to default by more than 2 times the base case to delay Maker's senior secured return, not even to blow it up. So these are really stable cash flowing assets that we feel provides a lot of protection for for Maker. Just graphically, the summary, I won't go through all of these, but you can see that the advance rate is a 93%, which means there's a roughly 7% junior layer in the capital stack. The proposed and hoped for return for Maker would be around a 3% IRR. We do have third-party costs associated with this, mostly the servicing and the payment agents. And then the debt service reserve account, as mentioned, would be about $2 million at close. And then Pando's yield would be around 75 to 80 basis points, or 0.75, 0.80%. Some of the benefits to Maker that we've touched on some of these already, but we'll dig in a little deeper. Again, these are investment grade rated assets that are highly structured and cash flowing assets. The DAI will be backed by that stable collateral, but it's uncorrelated to the crypto market. There is no technology risk in this transaction. These are all state-of-the-art, commonly used solar panels. Pando as a team is exceptionally experienced in the solar space in particular, but we're very familiar and experienced in project finance lending. I've been doing it for 30 years, in addition to other team members who are very experienced in this space. We can repeat the structure should Maker want to do it, and it would be a very easily repeatable structure, whether it is continuing with rated solar loans or wanting to have possibly a higher return and not having a rated loan and just do a forward flow agreement with a Mosaic and others. And we can certainly increase the risk profile by either not doing rated loans or by working with other solar originators in the space. We feel it's, again, quite meaningful that Maker would be the first protocol to lend to a large clean energy project in the United States or globally. This is, to us, a really exciting place for Maker to be, right next to the Credit Suisses and Deutsche Banks, MetLifes of the world. I think it's a rightful position for Maker to take, and it's exciting for us to try to be a part of that. And importantly, there's a lot of attention on how cryptocurrencies work in the world. And we know that the White House, SEC, and others would be very interested in seeing how cryptocurrencies can both play a role in energy project finance, but also clean energy project finance. So we wanted to dig into a couple commonly asked questions we've seen, mostly in the forum, but also directly. These aren't all the questions that have been asked, but we thought that we would try to touch on them. First, how does this transaction compare to treasuries? Foremost, treasuries are perfectly fine and acceptable asset to invest in. We feel that treasuries are minimal risk, similar to an investment grade transaction is minimal risk. So while we don't have the full faith and credit of the US government behind our transaction, it is investment grade BBB+, which is a very solid risk profile. And a lot of entities, financial institutions, do invest in treasuries as part of their overall investment strategy. They also, however, diversify their portfolio to have a mix of investments that include both treasuries as well as other rated assets. If you want to take a quick look at the chart here, you'll see the return of principal, which is a differentiator between what we're proposing in treasuries. So as I mentioned earlier, there's a weighted average life of 6 years. So by year 6, 50% of your principal would be returned. Whereas with treasuries, as you'll see this orange line at the far right, that's the full return of principal. There are upsides to the return of principal not being happening because the treasury is required to pay interest on the full amount of principal every year. But in terms of the liquidity needs and a quick return of capital, there is a meaningful return of capital in the in our transaction as compared to treasuries. One way to look at it, we just put at the bottom bullet here, you'll see around 110 or so million at the end of year 5, which includes 86 million of principal versus 30 million of interest being paid by a treasury bill, a 10-year treasury. So again, it doesn't mean treasuries aren't good. They are a very good investment tool, but having some diversification is helpful as well. Next, we know there's a lot of conversations about bonds and trying to compare this transaction to bonds. We have respectfully disagreed that this is a bond simply because it's not a bond. It is a loan. The assets underlying the loan from Maker are all solar loans, and they're not being publicly traded or publicly offered in a bond. That being said, when you compare Mosaic's price for its bonds compared to GoodLeap and some of the other solar originators in the space, Mosaic is consistently priced lower than their peers, and there are reasons for that, which we outlined in the MIP6 reply. We're happy to get into that if it's helpful. But also at the request of Real World Assets core unit team, we were asked to confirm with 2 investment banks that the pricing that we're being offered by Mosaic is consistent in the solar bond space, and RBC and Citi both agreed that it was. We did have that conversation now 4 weeks ago, so obviously things have changed, and we will keep looking at the overall pricing for this transaction since it's not currently set, but we still feel very strongly that this is a well-priced proposal to Maker, especially when it's measured against the risk profile of the transaction. A little bit further, just importantly, kind of on the whole bond versus loan front, loans are not publicly traded like a bond, so it is difficult to compare a bond to a loan. Typically, private loans, they do not share pricing, and as they're not traded, it is not easy to find public information about that. But when a loan is sold, a new buyer does not look to a publicly traded asset as a comparable. What they do is they look at the cash flow from that loan, that existing loan, and they just apply a discounted cash flow methodology to that, and that comes up with a price they're willing to pay. We feel that even with a really steep discount, we could return Maker's capital relatively quickly should we need to liquidate your position. And we feel depending on the year that you would need to do that, we could easily return 100% of your principal. Again, it's using the discounted cash flow methodology, not looking at a publicly traded bond.
Peter, just to interrupt for a second, there is a question on the treasury slide. Go back to that for a quick moment.
You bet.
I'll go kind of back to the beginning. The first question is kind of the discrepancy in the yields between the Pando loan and the treasury. When this slide was built, the 10-year curve for the treasury was higher than the yield that we were offering. You do see a little bit of discrepancy there. And as Peter mentioned, because you're paying interest on the full amount of the principal over time, the interest does build up more for the treasury versus the Pando loan. Also, the last question is wouldn't the yield be less for shorter duration bonds? In a normal world, that would be true. I do think the curve has been inverted quite a few times this year, where shorter tenor treasury notes have actually had higher yields than longer tenors at various points.
Thanks, Morgan. Any more questions on the slide while we're here? Okay, yeah, and just to the point on the difference between interest payments between the our proposal and a treasury, as Morgan mentioned, because the return of principal doesn't occur until year 10, you're having higher interest payments over time. But the counterbalance to that is you're getting more of your capital back quickly in a loan scenario. Okay, back to this slide where we've been asked a few times, is Maker the only capital in this transaction? Meaning, is there any junior first loss capital? So the answer to that is yes, there is junior first loss capital, which we did describe earlier. And it's not just junior first loss capital. There is a debt service reserve account as well as Pando's yield. That residual cash flow is typically something that's sold by Mosaic to a counterparty. It is obviously available to Maker if you want to increase your return, because that residual return is usually higher. But our assumption is, given that Maker was mostly interested in rated loans, that since that is unrated, you would not be interested in that. And so the short answer is yes, there is first loss capital in this project. And we are very aware and have read, not just with our proposal, but with other proposals, the concern around asset liquidity. Excuse me. And so we do both understand the importance of that, and we do understand the difference between liquidity from the perspective of the cryptocurrency world versus the real world. And so while we are unable to provide liquidity from the standpoint of hours or even a couple days, these are highly sought after, cash flowing, very stable loans. And so we have a great deal of confidence that we could get Maker out of your loan should you need to liquidate within what would be considered a pretty reasonable time period from the real world, roughly say 3 months or so. And again, the entity that would come and try to take over your position would just look at that discounted cash flow. So it would really be a matter of timing versus how much you want to recapture. The shorter the time frame that you need to exit, the worse the price. The more time we have to find multiple buyers and have them bid against each other, and not apply too much of a discount, the better the return to principal and capital would be. So again, really.
I want to add here, Peter, if you don't mind. I did see some comments as to in a loan sale, typically you have to do it at a discount. That's actually not the case with these assets. Because of the shorter tenor loans, the 5 and less than 10-year kind of amortization schedules mixed in, as well as the large prepayment that comes from investment tax credit proceeds for a number of the homeowners, using a discount rate on those future cash flows at something even much greater than the underlying rate of the loans in the pool still provide substantial and more capital available to pay down Maker's remaining principal than would be still outstanding at that time. And we can obviously show kind of that math if it's interesting to anyone. But we want to make it clear that in the event that we have the time, as Peter indicated, to sell the position in a reasonable fashion, we fully expect that we'd be able to repay all of Maker's principal in that scenario.
Thanks, Morgan. So moving on about Pando's alignment with Maker. In this transaction, Pando is the borrower. And so obviously there is an element of misalignment with all borrowers and lenders, but there is also natural alignment between borrowers and lenders. We are obviously highly incentivized to make sure that Maker receives its full principal and interest payments and achieves the return that we are focused on, because without that, Pando receives nothing. So we are fully at risk. We are not being paid, and we're not proposing a guaranteed fixed fee. I know there's been some confusion on that point. Being paid a guaranteed fixed fee would be not uncommon in this sort of transaction. And so we could have gone down that path. However, we felt that in order to really demonstrate our alignment with Maker, we would structure our yield as at-risk yield, an at-risk return, not a guaranteed fixed fee. Because of that, We are junior in the cash flow waterfall to Maker. So any cash that Maker needs to catch up in the downside scenario would come from, again, the reserve account, from the residual layer, and or from Pando. And so we're very comfortable with that position because, one, we want to be aligned with Maker, but also we are very comfortable with the assets that we're lending against, and we feel that both Maker and Pando are in strong positions. Now, getting away from the FAQs and trying to dig a little
Peter,
bit.
Just to jump back, I think there are two other questions and the Q&A. Let's take some time on those.
Okay.
Yeah, the first question is more of a hypothetical question, is why we'd want to exit performing loans. It's a good question. It's not one that I think that we're in a position to answer.
The only reason we would exit a performing loan would be if to address the liquidity concerns of Maker. So we would exit that loan only, I mean, from a Pando perspective, we would only exit that loan if Maker required it from a liquidity perspective.
And then the second question is whether any of the other current Mosaic lenders would be willing to take a portion of what we're offering to Maker in this transaction. And we have not had any conversations with any of those lenders at this point.
Yeah, and so part of the reason that we probably wouldn't want to go down that path, although some of those lenders would probably take the residual, that junior capital position. So there would be someone at that institutional level being a part of it. One of the reasons why we don't feel it's the best idea to have someone as a co-senior lender with Maker is, in that instance, we would need things like intercreditor agreements that take a long time to structure. And there really is no huge incentive for those Credit Suisses or Deutsche Banks to go through that process when they can just lend directly to Mosaic. They don't need to co-invest as a lender with Maker. I'm not sure that there's a whole lot of upside for Maker doing that either, because in a scenario where you had someone who's, say, pari passu with you, you just both sharing the losses. There's no real particular. We understand, for example, in other transactions where there might not be a whole lot of clarity or certainty about the asset type or when the capital would be deployed, that having someone co-investing alongside of you is helpful, in particular if that co-investor is the entity that's underwriting and structuring the transaction, and you don't have a lot of ability to provide any sort of insight or influence into that transaction. You're effectively along for the ride. In that instance, having that entity have skin in the game is really important. In this transaction, we have full clarity on the asset types. We have full clarity on the creditworthiness of those asset types, and we have full clarity on when the capital will be deployed. This is not a facility that we will draw down and try to deploy over many months or even years. This is a facility that we will draw down, and the cash will start, the loans will start performing for Maker within 30 days. So there's a lot of reason why it would make sense for Maker just to stay in this as the only senior lender. So hopefully that's a helpful answer. Any more before we get into the structure?
Yes, there's another question. Again, bringing back to a comparison against higher yielding bonds from different originators, as well as a discussion of the discounted cash flow method for kind of exiting the investments.
Okay.
If you want to take a minute to read it, I can start to address it while you do that.
Okay, why don't you do that since I can't read the questions?
Okay. The question brings it back to GoodLeap's most recent offering, which is at a much higher level. You will find in the forum we addressed pretty explicitly why Mosaic's instrument price much tighter than GoodLeap, how their underwriting methodology is much tighter, and that's reflected in the spreads that they get in their public instruments, which again we state are not really an accurate comparison to a private structured loan. Having said all of that, the in asking what a particular comp might be for this loan, I think Luca in the forum actually did a pretty good job of explaining how a traditional lending institution for a private loan is going to compare against the risks of that transaction, their capital allocation strategies, and many other factors to figure out if the yield is appropriate for a particular transaction. There's not really a publicly available number to kind of look against, for a particular action or a unique bespoke transaction like this one. You really do have to look at the merits and the risk mitigation strategies available for this particular loan, and that's what's going to give you kind of the answer as to whether it's an appropriate or not.
Any more questions, Morgan, or is that?
Yeah, we have Tej from the Real World Finance Core unit who asked that question to follow up. Thanks for hopping on the mic.
Thank you guys for coming on. I very much appreciate it. So look, I think at a fundamental level, I disagree with that methodology, but that's not really what we're here to debate. I think you guys can make your case, right? Arguing that it's a private transaction, it's not to be comp to public transactions. To sort of synthesize, the argument here, right, is that Mosaic as an issuer has sort of alpha, right, that makes the Good Leap transaction not a viable comp, right? And your argument is if you look at Mosaic's transactions and how they're priced historically, you can see that the market is in fact giving Mosaic as an issuer that premium. Is that kind of the argument that Mosaic is inherently it's structurally a more powerful and better issuer?
So there's
Correct.
well, that's correct, but there's also just the fundamental topic, which I understand we disagree on, but I'm not sure why we disagree on, is that we are not proposing a bond to Maker. And there is I think we can agree there's a meaningful difference between a publicly traded bond and a loan, which is a private transaction. And so it's just quite simply, this is not a bond. If this were a bond, Maker would be bidding on this in the public markets, participating in a public auction for the bonds, and that's not what's happening. Mosaic does whole loan sales and forward flow agreements, which are loans, they're not bonds. The only difference that we're doing to the whole loan sale approach is that we're actually getting this rated, which is the only comparable kind of action as related to what a bond would have. Mosaic does not have their loans typically rated, but we asked for that to provide some sort of, to provide a level of comfort to Maker. And perhaps that's where the confusion is lying, is that because we're having it rated, but we felt that that was something that would be actually a benefit to Maker. So Tej, I'm not sure if that is helpful. But it's just, this is not a publicly traded instrument that we're
Look, I mean, we get that it's not publicly traded, right? That the premise is that if you look at what, from first principles, what this transaction is, right? You're combining a bunch of consumer loans into a structure. You're slicing up that structure and you're selling us a senior, right? So sure, it's not being traded in the public markets, and it's not being rated and traded in the public markets. It's being rated and traded in the private markets. Like, I get that there's a difference there. But I think when you think about what the structure is and what the risks are, you're combining a bunch of loans and you're selling off a senior to Maker, right? Which is a very similar structure to a securitization. So I think whether it's a project finance private loan or whether it's a project finance public loan, which in my experience should price tighter, I think the question is, in essence, what is this thing? And why is that essence not comparable to something that has a very similar essence in the public market? And I don't think this call is the place to hash it out, right? I think you guys have been very diligent, very responsive in the forums, and we're just dealing with the difference in methodology. So I'm going to recuse myself and let other people answer questions, let you guys finish your presentation. But that's kind of where I'm coming at it from. I think it's sort of, there's a semantics issue here, right? We're not arguing it's apples to apples with public transactions, but public transactions are there for a reason, right? Transactions are information, right? This is why people care about comps. And from my perspective, historically, it's very difficult to ignore what we have in public markets, because if we just do things in the shadows, it's a he said, she said type of vibe. But I'll let you guys continue and I'll hop off the stage. Thanks very much.
Yeah, and TJ,
Thanks,
you know, I appreciate the nice words about our trying to be diligent, and we really appreciate the conversations we've had with you. We feel that you've been really helpful. And just the only thing I can add to that, what you mentioned to kind of further clarify our viewpoint is, for example, Bank of America and JP Morgan do both residential solar loans and do residential solar bond purchases. And they treat those differently. They're different desks that do those. They're underwritten differently and they're understood differently. And so we're coming from that project finance loan side of the world, where those aren't publicly traded and publicly comped. And it's an entirely different asset. But certainly understand and appreciate all the help you've provided. I think it's been terrific working with you. Morgan, were there any more comments?
Yeah, there is. I'm going to take the top one and I'll read it. Let's say the proposal follows through, and in a couple of years, the worst case scenario of the U.S. government crackdown on DeFi and/or stablecoins materializes, Maker being one of the primary targets. What's your playbook?
That would go to the liquidity comment, where we could
first and
sell...
foremost, though, these are performing assets. Unless there's a reason to sell them, you probably would not in that scenario. If there is
Right.
some sort of the reason why the government is forcing you to sell off all of your assets, then it does go to the liquidity question that Peter has been answering. But
Right.
again, if these are performing assets, just because the government decides to additional scrutiny or to put some regulations, I don't see a reason why that would force the sale of these assets.
Yeah, any government regulation, and we have to be careful because who knows what a government regulation would look like. But in the kind of history of government regulations of financial markets, they wouldn't come after a performing loan that is totally uncorrelated to the crypto market. These are US dollars flowing from Mosaic to Pando and US dollars flowing from Pando to Maker. They can be converted to DAI, but this is a cash transaction. And if we needed to liquidate your position, sell your position, that would be that discounted cash flow method that all loans go through in order to try to recoup your principal.
Okay.
Any more?
Yeah, give me 1 second. I actually haven't read this one yet. There have been over $8 billion of consumer loan debt financing in the public market since 2020. Your pricing implies that these deals could have been done 6 to 12% cheaper in this project finance market. That implies these originators could have financed this $8 billion of assets at 480 to 960 million cheaper if using your approach. Why didn't they do this?
Yeah. Do you want to take it or want me to?
Go ahead. I can.
So consumer, again, we're using a general term, consumer finance. So this is not consumer finance. This is structured finance with a pool of assets. So in the energy infrastructure space, project finance is now a relatively mature market in the US, and it's tied to long-term contracted cash flows. So the loans that homeowners enter into with Mosaic are contracted cash flows. And so when you do a project finance, you don't look at the asset value, you look at the cash flows. And so what Pando would be lending against would be those cash flows. We would have a security interest in the assets, and we'd have a security interest in the Mosaic SPV. But the reason why most consumer loans are not, hearing some background noise, I'm not sure who that is, but the reason why most consumer credit loans are not using a project finance structure is because there is actually no contracted cash flows around that, whether it's a credit card or things like that. It's just not a project finance type structure. I'm not sure if that's a helpful answer, or Morgan.
Hey, it's Eric. How you guys doing? It was my
Eric.
question. Let me just follow up. So what you're securing is a pool of, you're doing a senior secured debt financing on consumer solar loans. Agreed?
Yes.
Correct.
There's been 8 billion of these securitized in the last 2.5 years. if your approach is right, they could have done this 5 to like 12 or 6 to 12% cheaper using your approach. I mean, these are big boys like Mosaic, Goodleap. They could have saved roughly $500 million to $1 billion using your approach. Why did they all do the less efficient, more expensive approach? If your market is there, it's the same collateral. They
But
could do
they're
the same
doing that,
project
though.
finance loan. No, they're not. You're saying they gave up $500 to $1 billion to do a
I'm not
less
sure what you mean
efficient
by they're
financing
not, Eric.
strategy. We can just
Eric,
disagree, but you're basically saying they're leaving hundreds of
On-
millions of dollars on the table.
okay, Eric, if I could answer,
Please.
Mosaic does do whole loan sales and forward flow loans. That's actually part of their funding strategy. Goodleap does the same. Tesla, Solar City does the same. Sunrun does the same. Vivint does the same. They use multiple markets.
Agreed.
But you just said they don't use that.
No, I said if they could have done it at your pricing approach, they would have done it, because you're basically saying it's 1 to 2% cheaper to use your approach in the public markets. So why would they ever use the public markets when it costs them so much more? I mean, they're leaving hundreds of millions of dollars on the table. I'm trying to understand why.
Okay, so sometimes the bonds are cheaper, sometimes the bonds are more expensive. It just depends, and different lenders are able to participate in different ways. Sometimes the bond desks max out and they can't have more exposure to a certain to a particular originator or asset type, but the loan desk can, right? So there's different desks have different risk exposures.
Okay,
And
we'll disagree. I'm gonna leave a final point.
Hmm?
400 million of this was priced last week. It's a little different collateral, but it's senior secured debt financing of consumer solar loans, Goodleap, at 5%. PIMCO, John Hancock, all the big boys paid 5% for a senior bond that is rated single A, so it's better than credit-wise in the bond you're going to deliver. And it's financing the same assets. So I look at this and I say, wait, all the big boys are paying 5%, for this basic collateral. Why would we pay 3%? I mean, if people want to, give you guys like a $25 million subsidy out of pocket, but that's really what it is. I just want to make that very clear. But we can disagree.
Right,
but that's what the market is, and it's been priced. And you've presented no credible comps. You haven't showed one data point of here's where our method trades. Show us a big whole loan pool. I'd love to see it. Say, hey, these 3 whole loan pools traded in the last 3 months, and here's how they priced. We need to see something. Otherwise, it's he said, she said. The difference is that I actually have shown a transaction where dozens of multi-billion-dollar funds price this. You haven't. You have shown no pricing comps at all, no data. And in talking to brokers in private, isn't that useful? You need to see public comps, and this is a public comp. Can you give us a public comp?
Hey, could we reply?
Yeah, I want a public comp.
Okay, so first, we provided you rationale for the difference between the Goodleap pricing and Mosaic's historical pricing in the forum. So would certainly look for Eric. We're letting you answer. I'm listening to you when you ask questions. We appreciate the same courtesy. So we did provide you, and if you'd like to reply to that, we can have a discussion in the forum on that for sure. The private conversation we had with 2 investment banks was done at your request, and so we followed up with that. When we last spoke, you said you would go and look for, talk to your contacts and find solar loan comps, and so that was something you said you were going to do. And again, just whether it's Luca or other people who have expressed this, people who issue project finance loans don't look to public comps. It's just not how that market is done. And I understand that it's not your experience, which is obviously more on the bond side and the ABS side of the world, but it is just not how a solar loan that is a private loan, structured project finance loan is done. It's just, it's I know we disagree on that point, but it is what it is. We've asked you for guidance on what you would like to see the maker's return to be, and we said we would do our best to see if we could get that, but we haven't gotten a reply to that. So we're happy to do what we can if you feel like
let me respond. We've provided a reply. No, the last week's bond pricing tells people where market is. Maker holders have to decide how big a discount they want, which is fine. But that's a very clear, very public pricing signal. That's the only one any of us have. You haven't provided any. I've
For
at
a
least
different asset.
or
Eric,
public bonds trade. You haven't provided a
If I
single
may-
empirical support to this.
Right. But
Eric,
again,
that hasn't been kind of explicitly said, and so I'll kind of lay it out. There's the underlying loans have certain cash flows associated with them. The financing against those loans has to fit within those cash flows. If the public markets for publicly traded bonds require a return that is greater than the cash flow available from the loans that are being structured, there's a mismatch there that doesn't work.
No, I get that.
Fundamentally,
Show us other
you
people
have-
doing trades at this level in size. In the private market,
being-
doing project finance. Show us.
Eric, I'm going to have to pause you there for just a minute. I don't want to get too deep into this subject. I think this might be a very good opportunity for a real world finance call, potentially as well, as a follow-up. So if there's an opportunity just to wrap up this last point so we can continue
Thanks,
the call.
guys. I appreciate your time.
Yeah, thank you.
Thanks, Eric.
okay.
Yeah, Morgan, if you wanted to wrap up your point there for that, and then like I said, able to move on. We got about 10 to 15 minutes left to finish up this call.
If there's only this much cash available to lend against, you have to price underneath that. If the public comps are this, you simply can't use it as a comp because it doesn't fit within the unique nature of this transaction. You have to look at the cash flows available that you're financing against to price it appropriately. That's what project finance does. That's what we have done. And that's why one of the reasons why looking at a public comparable at a higher price is not useful in this situation.
Okay, thank you so much. And
yeah, I do want to thank Eric for bringing up that point though as well. It's again more typical to what the community is used to seeing, and is a good thing to highlight for challenging some of the lenders that come into the ecosystem. So
for sure,
appreciate that discussion.
And we understand the project finance structure is certainly not a common structure for a lot of people, let alone in the community where it is obviously very different than a bond. So we thought this would just be a couple easy slides we can go through that show the cash flows and how this works. This is a relatively simplified view of it, but if I start at the bottom right, you have homeowners who have rooftops. There will be solar systems installed on those rooftops and pooled into a tranche. Mosaic issues loans to those homeowners based on certain criteria. Those loans are then pooled into a warehouse facility. That facility then is transferred to, and that facility, to be super clear, is a special purpose bankruptcy remote entity. So it is arm's length from Mosaic, does not have Mosaic risk associated with it. Pando would have an SPV that is in place that is the lender to that loan warehouse facility, and then has the rights to the cash flows coming from that customer payments. At that instance, the customer payments would just go directly to Pando's SPV, with Mosaic being the servicer with a backup servicer. Then stopping here and going to the maker side, this structure in the greenish boxes is really kind of how we understand maker likes to do this, but we can adjust it accordingly. But DAI would be provided to the Caymans or overseas trust, whether it's the Caymans, BVIs, or Bermuda, we can discuss. That trust, then we would at some point convert the DAI to dollars, and then the loan would be issued to Pando. That Pando then would provide debt service to the maker trust in the United States. That trust then would forward the debt service to the maker Cayman trust or overseas trust, and then that debt service would either cash or converted to DAI be returned to the maker vault. Again, super simple, straightforward structure, but happy to answer any questions on that. And then there's obviously within that structure, there are roles and approval authorities. We've tried to map our understanding of how Maker would typically do this, but we're open to working with Christian and others to make sure that we get this how you're most comfortable. But the long and short of it is the Delaware statutory trust in the United States and whatever the overseas trusts are, they can provide instruction, but there's only so much a trustee will do. So we need to make sure we work really carefully with Maker to make sure that you've got a comfort level. The good news is we're not drawing over a long period of time. This is a single funding of a transaction. So both Maker's community as well as the trusts and trustees would have instant insight as to how that money is being deployed. But going back to here, the trust is just an independent third party. They will have certain understandings of all the conditions, precedent, and cash flows are working the right way. They can provide some instruction to Pando, but again, I want to make sure we're all clear. Trustees are not the most bold and brave people in the world, so we look forward to working with Christian to make sure that we structure it in a way that provides as much protection and security to Maker as possible. So relatively straightforward, again, approval structure that we just overlaid with the cash flows. Any questions on that before we get into how Pando operates? Okay, so I'm assuming not hearing anything. We're good. We did want to touch base a little bit on how
Feels like
Pando...
we do have one question from
okay.
David in the Collateral Engineering Services Score unit.
Okay.
He asks not to harp on the lack of public pricing benchmarks. Does Mosaic have syndicated and participated loans? If so, what terms and what is the pricing on these?
Mosaic does do forward flow agreements as well as whole loan sales. Our understanding is that our price is comparable to those, but we can get back to you. We've haven't talked to them probably about the past 2-3 weeks on that topic.
They typically haven't been very open with kind of their private transactions from a pricing perspective, but we can ask them if we can get some indication of what those forward agreements are priced at in the recent market.
Perfect. And then just one last one from Tim Black. This deck is not on the forums yet, but we will make sure that it gets uploaded alongside with this video for further review.
Yeah,
absolutely.
Sorry about that, Peter. You can take it away then.
I think everyone's just super excited to talk about the Pando underwriting model, so we're delaying that. So this is a model that Morgan and I in particular have loaned and or invested tax equity in over $10 billion in transactions. It's something we've spent a lot of time and effort working on. We've deployed capital that, as we are lenders, and we've also been registered investment advisors deploying capital using this model. As you might imagine, this is not the model. It's just a screenshot of the output of the model. But you'll just see we look at everything from sponsor, technology risk, cap structure, market risk, project completion. If there is construction risk, there is no construction risk in this transaction. Operations and performance risk associated with both the technology, the operator, and the ongoing maintenance of it. Any tax risk associated with the transaction, infrastructure, legal, and political risk are all things we have very detailed, weighted assessments around. So this slide, I know, probably only provides a very minor snapshot as to how we at Pando underwrite transactions, but even with the Kroll rating, we would still perform our underwriting to make sure that we as Pando are comfortable deploying capital into these sorts of assets. And then just we'll wrap it up with who we are in a little more detail. On the top left is Dan Rosen, who's currently the chairman of Mosaic. He was a co-founder and CEO. Dori Rutkovitz was the head of product at Mosaic and led organizational development there. Morgan and I have both worked together as managing directors of a firm called Tax Equity Advisors, which was the tax equity fund that raised $500 million-ish from non-traditional tax equity investors to invest in the solar space. And we also were senior officials who helped build the Department of Energy's Loan Program Office. I've been doing energy project development and finance, mostly in the US, Latin America, and a little bit of Asia and Europe for 30 years. Morgan has a background in venture capital, structured finance as well. So I think we bring a highly experienced team to the table. We really, truly know what we're doing. We've been in the space for a long time. We've been in the energy finance space for a long time. We've been in the renewable energy space for a long time. So we're really, excited to interact and be a part of this transaction with Maker. So any questions
Peter,
about? Okay.
There is one last question. It's kind of a good one. I'm going to take it just because it'll be a little easier than it's a longer one.
Sure.
It's from Anonymous, so thank you for the question. Really what it's saying is typically people pool loans, call it hedge funds, before they are securitized, and there's a discount when they buy it so that they can kind of make money on the arbitrage spread. I want to take a step back from that. The way that Mosaic has set up their financing strategy is they have a warehouse facility that has a number of lenders that lend to that facility, where they pool the loans while they are being while the consumer loans are being underwritten, while the solar systems are being installed. That capital is more like kind of construction financing, and I'm actually not sure if they do that at a discount or at a premium to what they then sell those loans or then package those loans to either the public or the private markets coming out of that warehouse facility. I don't believe they have a lot of hedge funds and those types of investors in that warehouse facility. They're using more traditional lenders like the CS and JP Morgans and those sorts of folks. But I would put it more akin to a construction financing because it's project finance to a takeout term financing coming out the other side, rather than kind of a strict arbitrage opportunity which you would see in a more traditional kind of bond market.
Thanks, Morgan. So I do think we have a little more time, 3 minutes. So if there's any additional questions, happy to answer them here, or also happy to continue to engage in the forum.
Yeah, Peter, again, one last question, apologies. Asking what the minimum amount is using this transaction structure. We have assumed a roughly 250 million pool with Mosaic. For an example, they did about 570 million in consumer loans, solar loans in June. So there is a much larger opportunity available. We would have to ask them at what point it's small enough that it doesn't make sense to them. But I do think we could come down from the 200 some. I just don't know how far I can tell you we could go.
Yeah, they have a pretty high appetite and interest in these transactions from the traditional finance partners they have.
But we can query Mosaic and get a direct answer to that question.
Yeah, I guess I don't know if the question is do you want a higher amount or a lower amount? So depending on that.
They were asking for lower.
Oh, got it. Okay. Yeah, we don't know the answer to that, but we can, if you probably the better thing to do would be to have, if Maker feels like it needs to be lower, have us tell us what you think it would need to be, versus we don't want to do too many back and forths between everybody.
Perfect. Well, gentlemen, thank you again for making some time and having this thorough discussion. Thank you, Tej and Eric, for also hopping on the mic to add to the engagement. As a reminder, the green light poll for Pando's MIP6 will go live on Monday, July 25th. And the conversation is still ongoing. You can join it by going to forum.makerdao.com and searching for Pando MIP6. This recording will be posted on YouTube a little bit later, and the slide deck, as mentioned earlier in the call, will also be available within the forum as well. So Peter, Dory, and Morgan, thank you again for the engaging discussion, and everyone for joining, and we'll see you around.
Thanks. Appreciate the opportunity.
And thank you all for